Look, we've got to focus on the fact that your full-year guidance was raised. You're feeling positive about the way in which you're steering the company. You say you're at an inflection point. But why the second quarter being below expectations? What can you add to what you're seeing right now?
We had a great first quarter, as we reported 26% year-over-year growth, and it's in line with the transformation that we talked about, which is our combined tech platform business and our financial services business would grow 50% or more. It grew 54% year-over-year, and that combined with flat revenue for lending, and that was part of the plan. And we had our second consecutive quarter of GAAP positive EPS, in addition to growing our book value on a tangible basis per share by about 16% sequentially. We also guided the full year, as you mentioned, above not just our beat, but also above our prior guidance. So that's a positive overall outlook. We had not given Q2 guidance before. We typically give the full year and then the current quarter that we're in. So at the end of 24, we gave guidance for the full year and Q1, not Q2. The analysts are using their own estimates for that. And because we're taking a conservative view on lending will be down sequentially in Q2, while our tech platform revenue and our financial services revenue will continue to have strong year-over-year growth, but also strong sequential growth and continued profitability as well. So we feel really great about the business and the transformation we've made over the last 6 years.
Yeah.
The fact that we can grow revenue 26% on flat lending revenue is a real testament to the diversity of our business.
Hey, Darcy, but you can't feel great about the share reaction.
You know, any given day, it's hard to predict what's going to happen with the shares, but what I can say is the business is doing incredibly well. The strategy is working. We're really happy about the trend. We are taking a conservative view on lending, but that's prudent given how uncertain the environment is. If the environment becomes more stable, we'll be more aggressive on lending. But right now, there's no need to, and the environment remains as uncertain as it has for the last 6 months on rates.
Mr. Noto, good morning. It's Ed in San Francisco. A lot of the questions I got from our audience for you were about the capital you raised and your strategy going forward. There was convertible in 1Q. A lot of interest in that. I actually am not clear why, but the people want to know. So that's the question.
Yeah, I think people misunderstand the share count. First, we did 2 things in Q1. First, we issued a convertible note at 1.25% interest. That allowed us to redeem a preferred security that we were paying 12.5% interest on. So that is going to provide an interest savings for us, and we've already noticed all of the holders of that preferred instrument, and so that's being redeemed sooner than expected. We also bought back an existing convert that was trading well below its face value, and that was accretive to book value, and it was basically neutral on tangible book value per share. So there's some perception that it was dilutive. It's not dilutive on a tangible book value per share. I think there's just a misunderstanding on what the total ending share count will be in the future.
My colleague at Bloomberg Intelligence, Herman Chan, has a very clear thesis for you guys. You have a brilliant app, strong user interface, one-stop shop, and you're targeting young professionals. That's what they think. But the story really is this higher interest rates for longer environment narrative. How does that thesis work in that rate environment, Anthony?
Yeah, well, first of all, your colleague said it very well, and so we should consider having them being one of our spokespeople. But what I'd say is higher for longer is going to create challenges for financial institutions. We are very well capitalized. We have a 17.1% risk-based capital ratio, so we have ample cushion in our capital ratio relative to where we have to operate from a regulatory standpoint, and we have plenty of liquidity. That said, as we saw today, another regional bank was really challenged. We're also benefiting from really strong deposit growth. We had a record growth in deposits, $3 billion of new deposits, and 90% of our deposits are from direct deposit customers, which means we're their primary account, and it's very, very sticky. But a higher for longer will put stress on other people's balance sheets if they're not hedging appropriately the way we do. We hedge our loans once we grant them, so we don't have that interest rate exposure. We can also match what we're giving as an APY to our SoFi Money members against the loans that we're offering and the rates that they have to maintain a very high NIM, and we've been able to do that consistently. In addition to that, we also have the tech platform business, which is not tied to interest rates. And then in the financial services business, we have the Invest platform that's growing very nicely, good AUM growth, good member growth, and another source of diversified revenue for us.
We're a technology show, and we want to go into the specifics of your technology, Anthony. But I want to bring our audience that macro flavor that you so brilliantly give, because why are you more cautious on the US economy? Why are you seeing 5% excess of unemployment? Why are you seeing these interest rate cuts that you've now basically halved in your expectations for 2024?
Yeah, our balance sheet has grown quite meaningfully. It's about a $30 billion balance sheet now. So as we came into 2024, we had a choice. Could we come up with our own expectations for 2024? Could we use consensus expectation? Let's just take a planning stance that's really conservative. And the planning stance that we took then was that there would only be 4 rate cuts. The market was factoring in 6 rate cuts at the time. We also took a planning stance on unemployment that would be more than 5%. The market was well below that. And we also took a stance on GDP contraction that was modest. Well, here we sit today, 3 months later, and the market's only factoring in 1 to 2 rate cuts. So I'm really thankful we took a conservative stance going into the year, and I'm really thankful we still have a conservative stance. I couldn't feel better about the underlying trends of our strategy and execution of our business, but I don't think we're in an environment where anyone has a really strong, high conviction level on where rates will be. There's still a debate whether there'll be any rate cuts whatsoever. So we just can't put the business at risk, hoping that we can figure it out. So we're going to a conservative point of view.
We're short of time, Anthony. You're moving away from this kind of trademark student loans and refi business. Why?
Well, the strategy when I came in 2018 was to create a one-stop shop for all your financial services needs. There was no one providing all the products that you need for the big moments in your life and all the days in between. So we offer home loans, student loans, personal loans, in-school loans, checking and savings called SoFi Money, investing, insurance, small, medium business loan, lead generation, in addition to the tech platform business. So the strategy was always about building a one-stop shop for all your financial services needs. And that's actually resulted in a diversified business that allows us to make choices on what we grow versus what we take a conservative view on.